All right. Thank you so very much for coming to my channel today. We are going to talk about a very, very important topic. We've been alluding to that. It's the affordability issue all across the country, and it's not a demand problem. It's the fact that people can't afford to buy a new home. They all want to. Here in Maricopa, it's about $89,000 is the median household income, and now the affordability crisis has hit, and it's about $125,000 to $140,000 to afford the median house. This, of course, is a big disconnect. Now, and we have problems coming, and this is going to affect my investors, and it's going to affect first-time home buyers, because if you buy at the wrong time, it may take you 5, 10, or 15 years to recover from buying at the wrong time. Now, the builders are incredibly motivated to sell properties. Matter of fact, sometimes they even sell them at a loss because the land is eating them alive. The land is an alligator. They bought the land 2-3 years ago thinking it was going to be a great time to build homes, and then the market's changed. But their mortgage payments and their debt payments haven't changed. If anything, they've gotten worse because rates have gone up. And so the builders need to sell their properties. Now, this has caused a problem throughout the country. Everywhere you look, we have a problem with problems, and FHA is now the new subprime, because the debt-to-income ratio that allows mortgage brokers to write loans has been abused. Now, the prior administration hid all these things, and I'm going to tell you, here's some historical. Now, Michael Engelking, who is a national broker here in Phoenix, Arizona, he's vetted. If you're going to do business with me, I would probably be asking you to talk to Michael, because we're going to do business. And when we buy things, it's a process to buy things. It's not something we're just going to go out and buy things. It takes us a while. We plan. He's certainly part of the planning. Now, we've been talking about the fact that the debt-to-income ratio has really been abused, and typically what happens is a 43% is really, really high, and that, of course, is gross. Now, Michael, this is Michael Engelking with Nova Home Loans. Thank you so very much for taking some time with me today. I really, really appreciate it. This is a topic that really has been concerning me, because, my timing model doesn't tell me why things are going to happen. It just tells me what is happening, and we can certainly see this all across the nation, that the real estate market is certainly softening, and this might be one of the whys.
Right.
So when a buyer, just say just a young couple going to buy their very first home, they're going to go to a builder, because the builders are really the best place to buy at the moment.
Right. Yep.
And they're going to give them all kinds of deals. Now, the builder wants these guys to buy. They're going to do everything they possibly can. So they're going to entice them in. They're going to give them concessions. They're going to give them window treatments and front and back landscaping. They're going to give them all the appliances, range, refrigerator, dishwasher, and window treatments. And then they're going to give them financing. And oftentimes that financing goes to their own captured lender.
Correct.
So that first-time home buyer, who's never probably ever done this before, he's coming to a builder who really needs to sell. I mean, this guy has commission breath. He really needs to sell that. So what are you seeing? Privately, we were talking, you're hearing from people that have had this happen.
Yeah.
And what's been the experience?
Well, first of all, thank you, Michael, and it's a pleasure to be here with you. You are nailing it. The number one conversation that we have with home buyers who need financing is affordability. It's the first thing out of their mouth. It's often the reason why they hesitate to reach out to us. Like sometimes people, friends, real estate agents have to kind of give them a nudge, because they're like, oh, I can't afford it. The interest rates are too high. The sales prices are too high. So it is the number one objection that we get, is the financing and what the payment is. So this is a conversation we have to address right away. And ultimately, a lot of the times it doesn't go any further than that, because they really can't afford it. Sometimes they can. So what are the builders doing to overcome that? this is what
This
we
is
are up
obviously,
against,
yes,
right?
this is a big question.
As a private mortgage bank lending money, this is our competition is the builder, because the builder has figured out a way to buy the interest rate down and reduce that house payment that a regular retail mortgage company is not able to do.
Correct.
So how are they doing that?
How are they doing that? What's it costing them to do that?
Tens of thousands of dollars.
That's what I'm hearing. Just tens of thousands.
Yeah, it's when you're dealing with real estate and financing, you can look at it as a pie, right? There's only so much money that's going to go anywhere. There's only so much revenue that is created. So if the builder is taking tens of thousands of dollars to get that buyer in the door, maybe they're using that money to buy the rate down primarily. They might be offering other upgrades on the property, whatever they need to do to keep that buyer there.
Oh, yeah.
Mostly it's about payment. There are people that reach out to us and they will not have a conversation with us once they find out that the builder's rate is 4.99%. So if the builder's taking that, buying that interest rate down with their in-house lender, so they probably are an affiliate, often they own part of the mortgage company or they own the mortgage company.
Which lends you to think, whose side are they on?
Right.
You
I
know,
mean,
that's a pretty easy question.
Yeah,
that's
right.
a really easy to answer.
Exactly. So if they have a sales price set on the house, they are using some of that revenue to buy down that interest rate. So it's reducing the builder's revenue ultimately.
Their profit.
Their profit is down. Sales price might look good. They might be keeping sales prices up a little bit, but their bottom line is impacted by the amount of concession that they're paying to get that buyer in the door.
So let me just recap that. So if you're buying a house for $450,000, by the time you buy the rates down, and a lot of these buyers, because they are first-time home buyers and they're taking all of their money, understand is that when you're talking to an FHA buyer, typically what they do is they take all of their money and put it as down payment, which means they don't have money to get the washer, the dryer, the refrigerator, the window treatment. So the builder is also adding that.
Correct.
So they're capturing everything that this buyer needs, so to entice them to buy the property, and typically these guys are just skinnying in. I mean, this is real stuff in the industry. They're just barely getting in.
Yeah.
And they have to ask yourself, how much does that cost, Michael? How much does that cost for them to buy all these range, refrigerator, dishwasher, do the front and the back landscaping, put window treatments on, and then spend tens of thousands of dollars
on rate buy down? It's a great question, and I think that some of your research has shown that some of the builders might be paying $80,000, $90,000, $100,000 when it's said and done to get the buyer in the door. Between real estate commissions, they're often paying more real estate commissions too.
Yeah. They want to bring us in. We love commissions.
Yeah. So I think that depending on the price point, we are talking, nationally. I don't know, what is it? Maybe the answer to that. $70,000, $80,000, $90,000, $100,000.
We're hearing horrific costs. I heard just yesterday here in Phoenix that a local builder was offering between $65,000 and $110,000 in concessions, which leads me to this, Michael. Here's what my concern is because I think that FHA is going to be the new subprime. Actually, I think it's going to be worse than a subprime. I think this is the subprime. I think people are going to be really wrecked from this, and I think it's just a huge problem for us. So here's the question I have for you: if you pay $450,000 for a property, and you get $75,000 in concessions, there's that famous saying that says, price is what you pay, value is what you receive. So it sounds to me that you're paying $450,000 for a $375,000 house. And if you're doing, and I'd like to explore this debt to income ratio with you that FHA uses. And of course, this is kind of a discretion from the mortgage broker too, is it not? When they start getting to the point. I'll let you finish this, but my understanding is that you can go up to 43% of your gross income for payments, including your house payment and other payments, but that on certain circumstances, that you can get it up to 51%.
Yes. Okay. So when looking specifically at FHA, the banks will allow a higher income to debt ratio because it is insured by the government. So the bank doesn't have to worry as much because much of their loss or all of it can be protected by the government insurance on the loan.
So they're going to shift the liability to the government.
Right. They would never lend somebody money at that high of an income to debt ratio. So what we're seeing is we see FHA, this is total income to debt ratio. This is the house payment plus like their car loan and credit cards, right? But we see them get approved at 51, 52, 53%. Now, to put that...
and that's gross. That's before taxes. Is that correct?
We do gross, yes, before.
Wow.
It doesn't look at your take home, which sometimes buyers are very confused by that. Why would you use that number? I don't get to take home that number, which is... That's a smart buyer to ask that question.
Buyer,
right?
Yeah, we know why that is. That's because you get a bigger loan.
Right.
Yeah.
So what happens is, to give you an idea how high that is, you were talking about some of these guidelines with conventional loans are much lower. Like the written guidelines can be like 38%.
Correct.
But they do look at some overall risk, and if the credit is okay, and maybe they have a little bit of reserves in the bank, you can see these ratios get pushed really high. Now, the housing ratio is a hard stop with FHA at 47%, which is still high, but you cannot go over 47%
of your gross for your house
gross
payment.
with your house payment.
That's
every
pretty
month.
brutal in my world.
Right. But to go 52, 53% on a total income to debt ratio is quite risky. So the banks are willing to do it. Now, there are these programs that are like, people are familiar with the term subprime. They used to be a more common statement before the financial crisis. But there are programs that are like subprime. They call them non-QM, non-qualified mortgages, and they exceed these ratios that Fannie and Freddie have put in place.
Wow.
But even the subprime, like non-QM loans, they don't go over 50. Like they don't.
So this is worse than
it's
the
worse than a
subprime
loan. Yeah.
Wow.
Yeah. So when you say is the new subprime, you have a good point there.
So and I've been reading on some of these things, and I've heard that it used to be during the Great Financial Crisis that only 20% of the FHA loans exceeded this 43% guideline. And now I'm hearing it's 63% of all FHA loans written in the last 3 years have exceeded the guidelines.
I don't know.
Is this? Have you heard that?
I haven't heard that number, but with where interest rates are right now and sales prices, they probably are finding ways to make that happen. And maybe that's in hopes that rates will come down and it's temporary, but that's a risky position for the buyer to be in, to bank on interest rates coming down. There's people in these loans right now who got them a year and a half, 2 years ago, and they could have sworn that they would be back in a 5% interest rate right now, and they're not.
Of course, yes. It was buy the house and date the rate, I think was the the big catchphrase.
So it turned out to be a much longer dating period than anyone thought.
Yeah, they're going to have to get divorced. It's really been a bad one. So let's talk about my timing model, because my timing model is telling us something is coming. Now, I can see what is going to happen because my timing model is telling us that we're going to have a correction. This happened in 2006 and 2007. Remember, I've been around for a long time, so fourth one I've been through, they all look pretty much the same. And I'm going to tell you, in 2007, the buzzword was nothing's affordable. And I'm going to tell you that here in Phoenix, in March of 2006, not only were things not affordable, but there wasn't any listings. We had nothing to buy. In March of 2006, we had 2,940 listings in a city of 4 million people available for purchase. Now, Michael, 1 year later, 12 months later, we had 33,000 properties for sale in 12 months. Now,
I hope we're not going to see that again right now.
Well, something is going to happen. So my question to you is, let's put our thinking cap on. We've got builders that are very desperate. They're getting people who really They're filling all their needs. They can't. These people are taking all their money. They can't even afford appliances to buy in their house, and a builder is giving them appliances. They've got their own lender who, if you need to get up around that 47, 48%, 50%, 51%, here's a lender that's more than happy to do that because they're associated with the builder. They really want to put this deal together. Mm-hmm. Then they give them a 2-1 buy down or a 3-2-1 buy down. And 2 years later, their mortgage has changed significantly. Mm-hmm. Now, my concern is because I'm looking for, I know what is going to happen. I'm looking for the why. I'm thinking this might be part of the why, is that if you took $75,000 in concessions from a builder and you need to sell your house, what can you sell the house for? Mm-hmm. Because my world, it looks to me like you bought a $375,000 house, but you paid $450 for it, mm-hmm. and every time you overpay for a property, you really radically increase your risk. Mm-hmm. So, Mike, what's going on in your world? What are you hearing?
Well, there are people that have made these purchases the last 1 or 2 years, and many of them did do the 2-1 rate buy down. So I'll just give you an example how that works. If the rate is 7%, there's a 2-1 rate buy down that the builder or a seller can pay for, and you would start at 5% the first year. That's a nice payment. And then it would go to 6% the second year. And then after 2 years, it would go back to the regular 7%. Now, the buyer is supposed to qualifies for that payment. Like, they should be able to afford it. But again, the debt to income ratio might be quite high. It's an uncomfortable payment. So we are getting phone calls from people that are in those 2-1 rate buy downs, and they are concerned about their payment going up, and they are not comfortable now. And so they're trying to figure out what to do. And some of them do not have the equity in the house to sell the property.
Correct.
So
Correct.
That is a legitimate concern right now. So what are these people going to do? Are they going to contact the servicer and ask them to help them or modify the loan? There's no guarantee they're going to do that. The servicer will be willing to, you have to show financial hardship. It's going to impact their credit. Are they going to borrow money from family to make up the difference?
Every month?
Or at sale. I'm talking about if they were trying to sell the home to get out of it.
Oh, they went to sell the house.
Yeah.
Oh, yeah,
like
for
if
sure. I think they could be severely underwater.
Right. So we could possibly. It's kind of new what I'm seeing. I'm not seeing a lot of short sales right now. I'm thinking that with the phone calls that are trickling in, and if people are uncomfortable with their payment and they haven't been able to do the refinance now that their 2-1 rate has adjusted up, what are their options? There's not that many, because most people can't afford to come out of pocket to sell a house.
Well, they couldn't hardly afford to get into the house, let alone get out of it.
Right. They barely had the 3.5. Sometimes they don't even have the minimum down payment of 3.5%. Sometimes they've gotten assistance and they're already upside down because they've gotten down payment assistance as well.
Well, not only that, but what happens to the FHA mortgage insurance premium? That gets financed, does it not?
Yes.
So if you put 3.8% down as your down payment, don't you finance back 3%?
It's 3.5% down, and then it's 1.75.
1.75.
Upfront FHA insurance finance into the loan. So you're at,
So maybe you have less than 2%.
Yes.
Well, you have 1.75% equity in a property.
And if you have down payment assistance, you would be upside down.
Upside down. Wow.
So these are concerns that people are having, and it's likely if rates don't come down, we will start. It's not only just rates coming down, because you have to have the equity to do the refinance, right?
Correct.
So you can't.
And you have to get the value to
right.
be correct.
You can't just do a rate and term refinance at 100% or 102% loan to value. So we don't know where it's gonna go from here, but
so risk has entered the market in a big way.
The equity position is important, right? Because if you don't have the equity in the property, it limits your options.
So there's a fallacy that there's all kinds of equity in the real estate market. It doesn't seem to me that there's a lot of equity.
There are, if people purchased, back, during the pandemic and prior, there was so much appreciation there at that point. It's mostly in the last couple of years. If you could comment on this, if the cycle is up 14 and then comes down, and we peaked at 2022, then it could be that many of these buyers that purchased in 2022 or more recently would not have the equity to do the refinance.
Right. Yeah, and we're seeing that actually that here in Phoenix that our values have backed up a little bit. Not terrible. We're not going to wear the crown for bad business like we did in the great financial crisis, but we've seen properties drop from a peak, and we're down about 5 to 10%, which is going to wipe out all the equity. So the studies that we've looked at have put down the that you have we've if you purchased January of 2021 and beyond, you're probably underwater. That's just what our study is.
Okay.
So I think we can say that risk has entered the marketplace. People still need to buy homes. We have the millennials doing household formation now. You know, and a lot of people have really good jobs. We can't tell them not to buy a house. They should be buying a house.
Right.
House is a really good thing for them. You know, and house isn't always economic. We just want to make sure that they can afford the house because if you're strapped financially, that house can be very onerous and cause lots of problems. So are you seeing people coming to you, Michael, for counseling?
Definitely. Because we do want them to come speak with us, even if they think that they can't afford the property, right? Because we want to put together a path to buy.
Correct.
It's it might be 6
Home
months, a year
ownership's
out.
great.
Right.
Yeah.
So, a lot of this is not, don't buy, because there are people that can't afford the payment and they just need to know what they're getting themselves into. So, some people we have to decide on, where the rates need to be in order for them to afford it or a sales price before they can do that. And so maybe we just let them know this is what has to happen before you can buy. And then they feel good having that conversation with us that they can make a good financial decision.
So to make a plan.
Yes. So my suggestion would be if you're paying rent or even if you want to try to move up, you want to buy another property, is to have a consultation with a mortgage professional and get the plan put together so that you're not just wondering what to do or you think that you can't afford, maybe you can't afford it, and what position do you need to be in to buy in the future.
Now, conversely, if you can afford it and you've saved, like I did when I was young, we saved our money. It was a really interesting thing. I mean, getting a house was like one of the top goals in your life was to get a house of your own. These builders are great targets. We can go up and beat the daylights out of them. If you can get financed, you can make a pretty good deal from a builder.
Right, and also from a traditional seller too. I mean,
yeah. They're getting a message now.
That's why we're being cautious right now, right, with the affordability and the values of home and what's going to happen. But there is an opportunity for buyers. I mean, if you're paying rent and you can afford the house payment, I mean, you own that negotiation right now with the seller. I mean,
100%.
We are seeing offers with below asking price that get accepted. We're seeing all the realtor compensation covered. We're seeing rate buy downs. We can do rate buy downs like the builder can too if you can get the concession from the seller, right? So a buyer could be put in a pretty good position right now.
Yeah, so we're getting statistics that are 500,000 more sellers than buyers. So a buyer's in a really, really good shape. Well, so it's a process, Michael. So I'd like to wrap this up. Let's just say, so in my business, I do basically investments. Michael handles all of our investment work. And we have been to the point where we've been paying mostly cash because there's a lot of risk in the marketplace that is shortly going to change. Now, remember, I've been in business for 50 years. And in 1981, a 7% mortgage looked pretty doggone good. So remember that we've traditionally had mortgages between 6 and 9%. This is pretty much standard. This is nothing wrong with that. It's a 30-year mortgage, and there's only one place in the world that offers that. That's here in the United States. It's just a gift to us. Now, Michael, now I know you do my clients. Do you want to plug yourself a little bit so where people can get hold of you
Sure.
and reach you? Because what you're saying fits right into our program. We're certified real estate investment advisors. We want to make sure that this works for you and that it's a financial decision. It's also an emotional decision. We understand that. But we want the buyers to walk away from this and say, I'm going to do really, really well with this. I'm very happy with this, and it's good for my family. So can they reach you and talk with you?
Yeah, absolutely. So if whether you are an experienced investor and you want to add to your residential portfolio, and you would like to have a consultation around what those investor rates look like, how much money down do you need, what do you qualify for, all the different programs that are out there. We love helping investors, and you can reach out. We'll put all of my contact information
Sure,
here.
love to. Yeah, we should do that.
And there's no cost to have a consultation with us. And what we will do is, it's okay not to buy right now. We will put you on a path to buy.
Yeah, just because you can doesn't mean you should.
That's right.
Yeah.
Right. And then also the more traditional buyers, that are currently renting right now that would like to buy a home, the first-time home buyers. We have great first-time home buyer programs. Buyers that are relocating from other states. And,
Absolutely. Phoenix is a great magnet here.
right. People are, there's new household formation, but there's also separation, and people need to sell and buy, going through a divorce. So we like to help all of these people, and it's okay to have a consultation. Don't feel like you can't do anything right now until you have a conversation with a mortgage professional and you have a plan put together. It's okay not to buy right now. It's not okay not to have a plan.
Correct. That is such great advice, is that we do this with a plan. We decide, we make decisions. It's not run out and do something. Don't run to the builders without representation, because the builders are really desperate. They want that business, and builders are making great deals. I mean, I'm hearing from my broker friends that they're getting great deals. So they don't want to give those deals, of course, but they are getting great deals. Well, listen, if you like the video, give me a thumbs up and subscribe. My very, very best to you guys. Thank you so much. Bye-bye now.